Right now, your retirement account is making a bet you never agreed to. Not a small one. If you hold a target date fund, an S&P 500 index fund, or almost any broad market index inside a 401k, you are carrying a concentrated position in artificial intelligence infrastructure in Nvidia, in Microsoft, in Meta, in Alphabet that grows larger every quarter without you doing anything. The structure of passive investing made that allocation for you. You never chose it. You probably do not know how large it is. Here is the number that makes this concrete. The top 10 holdings in the S&P 500 now represent roughly 35% of the entire index. That is the highest concentration since the dot-com peak in 2000. A retirement saver contributing every paycheck to a broad market index is not buying the market. They are buying a portfolio that is heavily weighted toward a small cluster of technology companies whose valuations are built on AI revenue projections that have not fully materialized yet. This is not the first time this structure existed. In 1999, millions of Americans with retirement accounts thought they owned the market. What they actually owned was a concentrated bet on Cisco, Lucent, JDS, Uniphase, and a handful of other infrastructure companies that were going to build the internet forever. The mechanism that put those companies at the top of the index is the same mechanism running today. The mechanism is called passive index concentration. It works like this. When money flows into an index fund, the fund must buy every stock in the index in proportion to that stock's market capitalization. The bigger the company, the more the fund buys. The more the fund buys, the bigger the company gets. The bigger the company gets, the more of the index it becomes. The cycle feeds itself independent of whether the underlying business is generating earnings that justify the price. Think of a single lock on a river that every boat in a region must pass through. When traffic is flowing, the lock looks like infrastructure. When demand reverses and every boat needs to exit at the same time, the lock becomes the problem. Passive index concentration works the same way. The mechanism that pushed capital in is the same mechanism that pulls it out at scale simultaneously without anyone deciding to sell. 3 steps. First, retail inflows into passive funds have averaged over $500 billion per year for the past 5 years. Every dollar that enters a broad index fund buys more Nvidia, more Microsoft, more Meta in proportion to their current weight. Second, those weights have grown because prices have risen, which means the funds must keep buying, which pushes prices higher, which increases the weights further. Third, the valuations sitting on top of this cycle are now pricing AI revenue 5 to 8 years into the future at growth rates no technology sector has ever sustained for that long. The business case for AI may be entirely real. The valuation sitting on top of that business case is a different question. The last time this exact mechanism ran at this scale, most of the investors inside it did not understand what they were holding until after the price had already moved. In March of 2000, Cisco Systems was the most valuable company in the world. Its market capitalization had reached $555 billion larger than the GDP of most countries. The surface narrative was rational. Cisco made the routers and switches that ran the internet. The internet was real. The infrastructure build-out was real. Analysts projected that global internet traffic would keep doubling every year, that enterprise spending on networking equipment would compound indefinitely, that Cisco's position at the center of that infrastructure made it effectively irreplaceable. Institutional investors were buying. Retail investors inside index funds were buying without knowing it. The logic held together as long as you did not examine the valuation underneath it. What was actually happening underneath was the same 3-step cycle described in part 2, running in the opposite direction from where it had started. Cisco was trading at more than 100 times earnings. The growth assumptions baked into that price required conditions that could not persist. When enterprise IT budgets began contracting in late 2000, Cisco's revenue missed projections by amounts the market had never priced. The stock fell 86% over the following 2 years. The business did not collapse. Cisco is still operating today, still profitable, still relevant. But an investor who held Cisco at its peak in 2000 had to wait more than 20 years to break even. The investors who lost the most were not speculators. They were retirement savers inside index funds who thought diversification protected them. It did not, because the index itself had concentrated around a single theme. The asset is different today. The concentration is the same. That one sentence is the only place in this video where the parallel is made explicit, because it does not need to be made more than once to be understood. There is one honest place where the parallel breaks down. Cisco in 2000 had operating margins under 20% and was already showing revenue deceleration when the market was still pricing in acceleration. The largest AI infrastructure companies today are generating real cash flow at margins Cisco never reached. The business underneath the valuation is stronger. That matters. It does not resolve the concentration risk. It changes the degree of it. The historical record does not promise an outcome. A pattern is not a guarantee. The dot-com correction ran for 2 years and took 78% off the Nasdaq before it stopped, but the internet did not disappear. The infrastructure that got overvalued in 2000 became the foundation for the next 20 years of economic growth. The investors who lost were not wrong about the technology. They were wrong about the price they paid for it and about how much of it they were holding without realizing it. Right now, the 10 largest companies in the S&P 500 account for a larger share of the index than at any point since the late 1990s. Most of those 10 companies are directly tied to AI infrastructure spending. A retirement saver contributing to a standard target date fund is not making a neutral bet on the American economy. They are making a concentrated bet on a specific technology cycle at a specific moment in its valuation history. The question is not whether artificial intelligence is real. The question is what you are actually buying when your paycheck hits the index every 2 weeks, and whether the price already reflects everything that has to go right. The mechanism does not care whether you understand it. It runs either way.